You know something I find interesting? We've been told time and time again by so many people who are bullish on the economy, including the government, including the Fed, that this is the best economy that we have ever seen. However, now everyone is whining and screaming for an emergency rate cut just because the stock market plunged a few percentage points. You know, they're all in terror over this, and those people, the same people who have been saying that this economy is so great and so robust, now we need this emergency rate cut. Well, why? Why do we need that? If the economy is as robust as they say it is, why do we need an emergency rate cut? Yeah, and in case you guys can't tell, I decided to come on over to Hell on Earth over here in San Francisco, so hopefully I'll make it to the end of this video. Honestly, it hasn't been so bad though, but I am over on the west side of the city and things are more relaxed over here. So who are the people that want to see this emergency rate cut? Well, you can kind of divide it into two different people. The first group of people are perma-bulls. These are people who are almost always bullish on the stock market, no matter how high it goes or how high the valuations are. They always blame the Fed when the market goes down, and when the market goes up, they think somehow they're genius investors and no one else knows anything. And the other group of people that want to see an emergency rate cut are basically people who want to see the Biden administration get reelected, because if there's an emergency rate cut, then that might help boost the economy just until the election time comes around, and that might be enough to actually get whoever's next in line elected on the Democratic side. The thing is, guys, none of this should be anything that the Fed has to worry about. You know, they have a dual mandate, which is to keep unemployment as low as possible while keep price stability. That's what they're supposed to do. They're not supposed to play politics. They're not supposed to worry about if the stock market is up or down, anything like that. So what is the emergency? You know, there is no emergency, and there's nothing that calls for a rate cut right now, if you look at it through that lens of what the Fed is supposed to be worried about. And you know, all these people that are losing money right now in the stock market that are screaming for this rate cut are getting what they deserve, first of all, because they're probably way over leveraged and, you know, have too much money in overpriced assets that inevitably will come down. But somehow they think, oh, I'm supposed to invest in this and it's supposed to go up forever. That's not how life works. That's not how being an investor works. So all these people that want to have this emergency rate cut need to grow a pair, put on their big boy pants, and understand that sometimes you have to take one for the team and you take losses, guys. That's part of being an investor. No one wins all the time. And if you thought you were just going to continue winning forever and that this stock market was going to go up forever, then you're delusional, because that's never happened before. And you know, the other thing is this, like, if this is a crisis, if this is something that calls for an emergency rate cut, wait till things really get bad and you see the market go down by 20, 30%, maybe even more. What are those people going to be doing then? They're going to be jumping off the bridge around here. You know what I mean? They're going to be suicidal. Now, maybe not to that extent, but you know what I mean. I think people have gotten so used to how good things were for a while there because of all the stimulus that, you know, we really never had before. And now all of a sudden everyone thinks that it's supposed to remain like this forever, that somehow you're never supposed to see the values of your shares go down. Like, that's not real life. And this is something else I mentioned in a video a couple days ago. Like, you guys need to watch out for this. If there is an emergency rate cut, which there might not be, there probably won't be, but if there is one between now and the next Fed meeting in September, if you see that, that's literally you seeing the Fed hitting the panic button in real time, okay? Because an emergency rate cut is the panic button. And really, the emergency rate cuts should only be for, you know, extenuating circumstances, like they did it during COVID. You know, they did it when we had the World Trade Center in 9/11. You know, so there are crazy things that can happen that may warrant the hitting the panic button, but having the stock market go down a few percentage points in a week is not one of them. So people who are losing this money just need to get used to it, because this is the way things are going right now. And if they're smart and they're in it for the long term, they'll probably regain those losses in the future if they're patient and smart enough to wait. Because that's the other thing, you know, people panic, they sell thinking that, oh man, I'm gonna be just losing all this money, but they're failing to wait for those gains to come back, which can take a very long time in some cases. Here we have a 3-bedroom, 2-bath house for sale for $1.6 million, and it's already pending. It literally flew off the shelf, this one. They listed it on July 5th, and by July 19th it was already pending. And the current owner's property tax bill is about $8,000 a year here in San Francisco, but when they buy this house, it's probably going to be more like 30 grand a year. But I'm not surprised this one flew off the market, because later in the video you'll see another house for sale that is a lot more expensive, that isn't a whole lot nicer than this one. It's a little bit bigger, but still guys, even to pay $1.6 million to plop that kind of money down to live in a city like San Francisco with all the problems and all the crime sounds like a pretty big risk right about now. So now what all these investors and traders are doing is they are banking on the fact that when September does come around, if there's no emergency rate cut, when they actually do cut rates in September, it's not going to be by a quarter point, it's going to be by half a point this time. And a lot of these investors are banking on the fact that the federal funds rate is going to drop by 2.25 percentage points by the end of next year. So right now, if it's at 5.25%, that means by the end of next year that we'll be down to 3% federal funds rate, guys. I don't know, maybe. Anything's possible. What I do know for sure is that these are the same people that made the predictions that this year we were going to see 7 rate cuts from the Fed. So I wouldn't hold your breath if I were you. Check it out, driverless car. I knew I was bound to see one of those over here. Now, according to an economist from Citigroup, he says this: the unfortunate reality is that a range of data confirm that the rise in unemployment rate is now prominently signaling the U.S. economy is at best at risk of falling into recession, and at worst already has. Well, if you guys have been paying attention to my channel recently, one thing I've been talking about a lot, which is extremely important and relevant to what's going on right now, is the SOM rule. The SOM rule is an economic data point that was invented by Claudia Sahm, who used to work at the Fed, which pretty much just says if the 3-month moving average of unemployment rises by more than 0.5% in a 12-month period, that signals we're already in a recession. It doesn't mean that a recession's coming, it means that we're in a recession. And this data point was recently just triggered, with the rise from unemployment going from 4.1 to 4.3% month over month. So you guys know my stance on this. I hope that the Fed does not cut rates, even though I know they probably will, and especially I hope that they don't do an emergency rate cut. But if they do, just understand that's the panic button, okay? And everybody, if you see this happen, then you know 100% sure that things are going to go from bad to worse very soon. And most of the level-headed economists and people out there are saying that no, the Fed shouldn't do an emergency rate cut, and I agree that they should not. But hey, what do we know? And at the end of the day, we don't really know what their motivations are when it comes to politics or their own finances. But you got to understand, we're also trusting the same people with our economy and the health of our economy who said that inflation was transitory, back in 2021 and 2022, which proved definitely not to be the case. So really, whatever they do next, you have to take with a grain of salt, since they don't have the greatest track record of accuracy or knowing what's really going on. Now, I saw this story today that says 6 reasons a recession is unlikely, guys, and I'm going to go over them with you because I can debunk all of them with all of the recent things we've been talking about here on the channel, to just show you, number 1, how much of a lie this is, but number 2, they're out of ammo. The people who are making the case that there will be no recession have nothing left to say that makes any sense, okay? Their first reason that they're saying there's going to be no recession is because of the jobs market, okay? Even though we're starting to see the hiring slow down dramatically, you're starting to see the job openings slow down dramatically. At the very same time, we're seeing the layoffs ramp up. But they're saying the jobs market is a reason that you don't have to worry. They say, oh, don't worry about the jobs report that just came out in July, because it could just be a one-off and things might get better next month. And also, the numbers that we had all this past couple of years were unsustainable anyways, and we had 240,000 jobs being created per month. That's crazy. So now things are just normalizing. It's taking people a lot more time to find jobs right now if they lose a job, and you're more likely to lose a job right now, but yet somehow they're arguing that this is a reason that we're protected from a recession. Like, huh? But wait, if you think that's funny, it's gonna get better, okay? Because the next one is unemployment. You know, we just saw the unemployment rate jump from 4.1 to 4.3% for the July figures, and a year ago, unemployment was at 3.4%. So it's gone up almost an entire percentage point in just 1 year, guys. We don't see this very often unless, guess what? We're heading into a recession. They say there's not a ton of layoffs out there and the jobless claims are still very low. The unemployment rate is also still low historically speaking. It's only been below 5% for an extended period of time, a handful of times since the 1970s. Well, pretty soon, probably won't be below 5% for very much longer. And then check out this. Mary Daly, who's the president of the San Francisco Fed right here, she just said that firms are not laying workers off. Firms are simply slowing their rate of hiring. That's a flat out lie, guys. How do I know that? Well, because just this past couple of weeks, we've seen some major layoffs happen. You know, Dell just announced they're laying off 12,500 people. Intel is laying off 15,000 people by the end of the year. We talked about a few days ago, Conn's Furniture, huge furniture chain throughout the United States, been in business well over 100 years. They're closing all 553 of their stores, and it's the largest bankruptcy filing of 2024 to date. And how many thousands of people are going to lose jobs from all those stores closing? We literally just had the SOM rule get triggered with how fast the unemployment rate is rising. So to say that firms aren't laying people off and that they're just, hiring at a slower rate is a flat out lie. The next one, GDP. That's another reason that we're supposedly not going to hit this recession, because GDP went up at 2.8% in the second quarter. So we're all supposed to celebrate that. And I covered this in an earlier video too, but let's think about it, guys. Most of that GDP came from government spending. And we know this for a fact because of all the stimulus that has been happening in this economy still. And here's the thing, 70% of GDP comes down to one thing, consumer spending. And as you know, we've had a massive influx of illegal immigration into the country over the past couple of years. And all of those people come in and they spend money, right? They have to buy things. They don't just come here and magically grow all their own plants and have all their own food and don't have to go out in the real world and buy stuff. No. So to say that that doesn't have an impact and that doesn't contribute to GDP is also a huge lie. And it's also something that's not being acknowledged here. And if they want to just say, oh, it's because consumer spending is still good and people still have money, we have lots of things we can talk about here that prove that's not true either. Here's what they say. Households can still support steady spending because unemployment is still very low and wages are rising faster than inflation. That entire paragraph is a lie, first of all. Wages aren't rising faster than inflation and unemployment is rising rapidly right now. They say that two possible problems are a low savings rate and rising debt levels. Yet household debt is still below pre-pandemic levels. Households are still in good shape financially overall. On what planet? Where? Where is this happening, guys? All this spending that people are still doing, if any, is all on debt. People are taking out more credit card debt, more buy now, pay later loans than ever in history just to keep up with the bills, just to keep up with the rising cost of living. And that's supposed to be a good thing? That makes it good for our economy? Because with all these debt levels rising, so are the delinquencies on those debts. I also have some data I want to share with you guys later in this video about credit card debt hitting yet another new record high. Here's the other house for sale we mentioned earlier, and as you can see, they're asking a whopping $3.1 million. It's a little bit bigger. It's like, 700 square feet bigger, which probably is a lot of space in San Francisco, but still, guys, for it to be double the price is insane. They bought this house back in 2002 for $899,000. Now they want $3 million for it, but check this out. Current property tax bill is $15,000 a year. That's still a lot of money, but it's nothing compared to what it will go up to, because when they buy this house for $3 million, the new owner is going to be paying somewhere in the neighborhood about $50 grand a year just in property taxes, in a place where you can have a tent in front of your house tomorrow. You know, we also talked about a couple days ago all the new data that came out recently for people who earn over $100,000 a year are cutting back on their discretionary spending tremendously year over year because they're realizing that we are entering this recession and maybe I should start hanging on to the money I do have. You know me? What's your name?
Mayumi, we watch your program.
What's your name?
Mayumi.
Mayumi?
Yeah, that's Japanese.
Oh, nice to meet you.
We saw you walking there, and I kind of did that, but
oh, I didn't see you.
No, we were car.
Oh, you were in the car?
I begged my husband to make a new turn.
Awesome.
He said no, but.
You live around here?
I live in Western Recession. I used to live in 42nd.
Okay.
Wow, thank you.
It's nice to meet you, Mayumi.
Yes.
Thanks for saying hello. It's a pleasure. Thanks for watching. Bye-bye. That's so cool. First fan I met in San Francisco. Shout out to Mayumi. Here's the next reason they say that we don't have to worry about recession. Most businesses are still growing, especially in the huge service part of the economy. The latest ISM service sector index snapped back in July into positive territory. Another bullish indicator is corporate profit margins, which are on track to post their biggest increase since 2021. Again, another huge lie, guys. Why are the corporate profits soaring right now? Because they are laying off thousands, or not hundreds of thousands of people. Every time they do this, their profits rise because now they have to pay less people. It's not rocket science. So you have less people working for them and their profits go up and their share prices go up and the stock market goes up, and it makes it look like it's a good thing, except for the hundreds of thousands of people that literally just lost their job. And we know manufacturing is off right now. That is something that's been slumping for the past 2 years, but you see other big stores, big chains closing down thousands of stores like Walgreens and CVS. They're closing down thousands of stores across the country, especially in places like this where crime is bad, you know? You have restaurants cutting people's hours because they don't want to pay the higher wages, especially in places like here in California. But all those businesses are in good shape. And listen, I'm not sitting here saying that no businesses are doing well right now, because clearly that's not the case. In fact, the other day I gave you the example of debt collection. You know, that's a booming business right now because so many people are delinquent on their debt and it's going to collections. So therefore, these debt collection firms are having a field day. And there's always opportunity when things aren't going well, guys. It's just up to you to spot it and recognize what that is and seize it. And of course, the last argument of why we don't have to worry about a recession is because the Federal Reserve is going to cut interest rates soon. Well, history shows us that when they cut interest rates, it's because we're heading into a recession. Now, that's why they cut rates. If the economy was really good and people could still support these higher interest rates and businesses could still handle the higher rates, why would they lower them, right? There would be no incentive to lower rates. Like we talked about earlier, people are already screaming for this emergency rate cut just because the stock market went down a little bit. Can't handle that. It's a joke, guys. It's an absolute joke. You know, nobody can handle a little bit of pain. Everybody wants it to be an endless summer when it comes to making money and investments, and think that things are just going to go up forever and the Fed and the government should do whatever they have to do to support that. No, 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 no. That's not how things are supposed to work. You know, this is literally the worst argument I've ever heard on why we're not going into a recession. Literally all 6 of these points are complete bogus, guys. That's how you know that things are about to go from bad to worse, because the people on the other side of this argument can't even come up with a good reason anymore, or reasons that this isn't gonna happen, okay? Everything that they said is a lie. And I'm not sitting here telling you guys that I'm never wrong about anything, or that, you know, every business is failing and everything is collapsing. No, I'm not saying that. But I am saying that you need to use your brain and take a look at this and realize that, hey, maybe all these things that they're saying about how good everything is isn't actually true. You don't have to look very far to realize that's not the case. And speaking of consumer spending, I told you guys we're going to get into the credit card situation. Well, guess what? Credit card debt just hit a new record high. Yeah, that's right. It keeps smashing the old records, quarter after quarter, because more and more people are just sliding into debt, guys. And to make matters worse, the delinquencies are also going up. This is a brand new story. Some people say, oh, I repeat myself. Well, guess what? I'm repeating something that just happened, okay? Because the credit card debt continues to be a problem that is boiling out of control. And this is the latest stats on it. Literally, we have more Americans falling behind on their credit card bills at a pace that hasn't been seen since the aftermath of the 2007 to 2009 recession. And we're not even in a recession yet. Imagine how bad things are going to be once we actually officially are. Think about that for a minute. About 9.1% of credit card balances recently transitioned into delinquency over the last year. This is data that was released just now today, as I'm recording this, guys, on Tuesday from the New York Federal Reserve Bank. And this is balances that are 30 days or more overdue, and it hasn't been that high since 2011, when we were recovering from the last recession, which supposedly we're not even in one now, okay? And listen, guys, I didn't want to make this video today. In fact, I had other stuff planned that I wanted to talk about with real estate and some other things about business and the economy right now. But I had to make this video because I just can't believe what I'm hearing when it comes to the amount of people freaking out over this emergency rate cut situation and how many people are still thinking that we're going to dodge this recession somehow. It's a joke at this point. Total American credit card debt just ticked up to $1.14 trillion, a new record high, and the data shows that about 7.18% of credit card balances became seriously delinquent or more than 90 days overdue. That's also the highest that we've seen in 13 years. And you can see by this chart that the delinquencies definitely have not been this high since the last recession, and it's continuing to rise. It's leveling out a little bit according to the graph, but it is still in an upward direction. It's not going down. Then you have all these economists and people saying, oh, this isn't a reason to panic. Don't worry about the delinquencies going up. This isn't a big deal. Like, why not? Why isn't it a big deal, guys? They have no argument either to say why this isn't a big deal. They just say it's not a reason for concern. Oh, well, maybe not for you if you're the one who's able to pay your bill, right? And you can guarantee that these delinquencies and the credit card debt levels rising are a direct correlation with how much the unemployment rate has been rising recently, as well as how much the cost of living and inflation has gotten out of control. This is not a new problem, guys. This is something that has been, kind of boiling over the edge for a little over a year now. It's just that only recently more people are starting to take note of it because it's starting to affect them. It's starting to affect their neighbors. It's starting to affect their portfolio. This whole post-pandemic spending spree is over. People are not spending the money like before, and all this debt that's being added to these credit card balances is mostly for living expenses. It's not for going out and, doom spending and putting, vacations on the credit card. This is for buying groceries. This is for, making the insurance payment on the car and things that people really need. Literally, this story that I'm reading here to kind of finish up this video quotes the Morning Consult survey that I talked about a couple days ago, guys, which says that 2 out of 3 respondents said that they thought interest rates in general are too high, and 75% of that group said they've cut back on non-essential spending because of higher borrowing costs. And that's the reason everybody thinks that, oh, if the Fed does an emergency rate cut, this is somehow going to, bounce people back into buying houses and buying cars and all this. In fact, mortgage rates now are down to like 6.3%, which is the lowest they've been in a while. Is that going to be enough to get people off the sidelines? Probably not in most cases. In fact, a lot of people might get spooked by interest rates coming down like that because, they might think, well, rates are going to come down even further, or why are they cutting the rates so much? Everybody's going to start questioning that, just like we're doing here on the channel. When you see that happen, you realize that, hey, you know, they're trying to get me to spend more money, but I have less money than before. Maybe I shouldn't. So if unemployment continues to go up and more people lose their jobs, more people aren't going to be able to pay their credit card bills, they're not going to be able to pay for their car loans. You're seeing a huge repo crisis happening right now, according to my buddy Brandon. People aren't going to be able to pay these bills without a job. It's that simple. And the funny thing is the real professional investors, people that understand the market, people that understand the Fed and interest rates, if there is an emergency rate cut or they start dropping rates faster than they were raising them, a lot of people who are professionals in this space are also going to get spooked and realize, hey, they're finally realizing that we're in trouble. It's time to hunker down. You guys really got to start paying attention to all this stuff more than usual, because we're starting to see a lot of changes happen pretty rapidly. And if you're not paying attention, you're going to miss it, guys. So make sure that if you enjoyed this video, you are subscribed to this channel for more updates like this. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.